is assurance engagement and related services. Okay, before I move further into the topics, okay, I want to refresh back what you know better. Okay, because all this while you have been exposed to the audit of the financial statement. Okay, so audit of financial statement is also part of the assurance engagement, and then the structure or the requirement of certain criteria are there. Okay, mean whatever required things that need to be have to have in a particular assurance engagement, also have that in the audit of the financial statement. Okay, in the audit of the financial statement. Okay, so audit of financial statement. So what happened is that normally you have your shareholders appoint audit firm, okay, to do the audit on the company or management. Okay, why they do this is because, of course, this is actually a requirement of the Companies Act 2016. Okay, whereby a company must be audited by an auditor. Okay, simply because to fulfill the or to overcome the problems of the agency problems. Okay, because shareholders are the principal. Okay, and then management are the agent. Okay, so they want to ensure that management is actually acting on behalf of the shareholders, taken into consideration of the shareholders. Okay, so that's why the audit firm would actually review financial statement prepared by the management, and then after that audit firm will issue audit opinion addressed to the shareholders. Okay, so here if you can see, you have the shareholders, okay, you have the audit firm, and then you also have management. Okay, so here the audit firm is actually the practitioner. Okay, practitioner that actually think lambat Amy. Okay, practitioners is the audit firm. Okay, so audit firm is the practitioner. So they would actually look at the, the subject matter, which is the subject matter is the financial statement. Okay, so subject matter here or the scope of the work is actually financial statement, right? And then when they do the work, all the financial statement is actually being prepared by the management. We call it responsible party, which is the management, or sometimes we call them auditee. Okay. And then at the end of the day, when the practitioners do the work on the responsible party, okay, of course, later on, the practitioner will give the audit opinion, right, to the shareholders. So shareholders is actually the intended user of the financial statement, okay, which is the shareholders. Right, so in this case, this is actually very crucial. Why we need to know all these elements, okay? Because remember, all this must be stipulated in the engagement letter, okay? Because this will be the contract. All right, this will be the contract. So here we'll actually mention about your responsibility, what you need to do, okay, about your scope of work. Okay, it will define what the scope that you need to cover when you do your work. At the same time, you also have to look at the criteria. Okay, criteria meaning that when you prepare your checking your financial statement, your subject matter, okay, this one you have to ensure against what is your benchmark. Okay, how do you know the financial statement is actually true and fair? Okay, with regard to that. So that's why when we do the audit of the financial statement, our benchmark is actually MFRS. So this is actually later on you will see as a criteria. Okay, So this is what you are familiar with. Okay, all this while you are actually doing the audit, financial statement audit. So in an engagement, this is what you must have. Okay, that means you are able to identify in an engagement who are the practitioner, who are the responsible party, who are the intended user. Okay, so those are the parties that involve. And then in the case of the subject matter, which define the scope of your work, all right, so what is the scope that you need to cover during the engagement? And in order to do that engagement, of course, your scope of work would actually compare to a certain requirements or benchmark or guideline that to ensure that whatever required is actually in compliance with. Okay, that means the practice is actually in line to the required regulations, laws, and so on. Okay, so based on that, you come up with your audit opinion. Okay, so this is actually the final output of the of the auditors. Okay, that is actually the products of the auditors or practitioners. Okay, so here today we are going to look at other than audit of financial statement. Okay, because all this while you have been exposed to how to do the audit of the financial statement. Okay, so today we are going to look at other assurance engagement that could be provided by audit firm or practitioner to the company. Okay, whoever need the services. All right, because actually there are many more that can be provided. If I'm sure you have opened up the website of the audit firm, right? You can actually see. Of course, they have assurance services, and apart from that, they have advisory services. Okay, so this is where we call it advisory or consulting services. Okay, that means other than audit job. Okay, so there are many things that they can provide. Okay, why actually they look for audit firm? Okay, why actually they make use of the audit firm? So later you will see why when they need for this kind of engagement, this kind of services, they will look for audit firm or practitioners. Okay, when we're talking about assurance services, right, it can be the subject matter itself can be a very huge. Okay, it not specifically to be just financial statement audit. Okay, because when we're talking about financial statement audit, we are talking about historical information. Okay, because when you audit the financial statement starting from 1st January up until 31st December, let's say 2021. Okay, you come and audit after year end. So it's about historical information. Okay, and then of course review is also about historical information, but that one is more on the quarterly basis of reporting. Okay, all this will be explained later on in detail. So I just explain briefly here what are the main scope that actually will be covered under assurance services. Okay, so other than audit of historical information, the audit firm or practitioners also provide agreed upon procedures. Okay, agreed upon procedures means that between the practitioners and also the intended user, they already agreed. These are the procedures that the practitioners need to do, and these are the outcome they expect to get. Okay, that means they know what kind of report they want, so that it has been agreed, okay, between the parties that involved in that particular engagement. At the same time, the company might also want to ensure that they are in compliance to the laws and regulation. Okay, because some industry they are regulated apart from financial services. There are many other industry that are also regulated. For instance, like construction company, where those that build up the properties, where whenever they collect the money from the buyer, it should not go into their bank account. It should go into housing development account. Okay, because they have housing development act that they need to comply with. Okay, so that's why by right there shouldn't be any abandoned project lah. Okay, because whatever money collected or received should be used for the consumption of the project and so on. So where you could have this specific audit, okay, to just look at on this particular area Or maybe you want to look at the level of compliance on the environmental issues. Okay, the nature or extent of the compliance of the company with regard to the environmental policies, laws and regulation. All right, because for some company, they are highly regulated by the environmental requirement. Okay, it can be construction company where you build up your properties at the land, at the hills or whatsoever, or maybe manufacturing company. Okay, so there are certain policies that you need to comply with. Okay, so you can do a specific audit just to ensure that you are in compliance to that law or regulations. Okay, or maybe you want to do IPO, initial public offering. Okay, so meaning that you want to offer shares whereby you want to increase your capital injection into the company. You want to do an expansion. So in order to issue IPO, to go for IPO, initial public offering, you have to come up with the prospectus. Okay, so information in the prospectus must be verified. Okay, must be assured the information is credible, the information is accurate, reliable, and so on. So again, the practitioners can come in and verify that kind of information. Apart from that, internal auditors also might come in and do specific scope on internal control on the process. Okay, so maybe it's a new company, they want to establish their internal control. Okay, they want to establish their enterprise risk management. So they are not sure how to go about, okay, how to handle it and so on. So they might appoint practitioners to come in and provide consulting or advisory how to go about, how to design the framework, to design the process, okay, so that everything will be in place and so on, okay. Or it might not be a new one, it could be also existing one, but they want to improve. Also, they can do that. Okay, apart from that, they can also appoint practitioners to provide IT advisory in the form of trust services. Okay, because nowadays people use digital transactions. Everything is all digitalized. Okay, so the reliability, the security of the system, okay, within the company website, or especially when you collect payment, when you collect data and all those things. Okay, so people are talking about security, people are talking about the trust, how reliable you could trust that particular website. So this is also will be provided by the practitioners as well. Okay, but of course, before you provide this, you must ensure you have the capability to do it. Okay, so there are some checking that audit firm need to do before embark on all these kind of assurance services. So assurance engagement is defined as evaluation or measurement of subject matter. So here the keywords here is you evaluate. Okay, you evaluate a particular subject matter. Okay, particular subject matter. So subject matter here would actually refer to the scope of your work. Okay, so as mentioned just now, it can be anything that the company would like practitioners to assess. Okay, it can be appointed by the company itself. It can also be appointed by a third party who wants to do the work on another company. Okay, for instance, you want to do a merger exercise or you want to do a takeover. Okay, so you have company A, you have company B. So A would like to take over company B. So of course, A would like to know what is the value, okay, or the net worth of the B. Okay, what is the net worth of B in order for A to buy B. So for that matter, A cannot go into B to assess because definitely A would try to reduce the net worth of the company. Okay, to try to reduce the net worth of the company. So to make it independent, that's why A will actually appoint another independent party to do the work on the B, so that A would actually rely on the report given from the audit firm or practitioners that they have done the work on B to A. So here in this case, A will be the intended user B would be the responsible party that to provide all the management, all the information that required for A to evaluate, the net worth of the B itself. Okay, so of course, in order to do that, audit firm must be independent and also competent. Okay, that means audit firm is independent of A, audit firm is independent of B. Okay, that means they have no interest, right? They have no interest in A or B. And then audit firm also must be competent, meaning that they know how to do it. They know how to do the evaluation of the net worth of the company properly. Okay, so they must have competency. So here, you have to identify the subject matter. Okay, so what is the subject matter? So subject matter here is the net worth. So the net worth, of course, most of the time go back to the financial statement. Okay, so what will be the identified criteria here? Identified criteria, of course, when you rely on the financial statement, okay, definitely it will be MFRS. Okay, that means you want to ensure that when they do the valuation of the financial instruments, when they do the valuation of the items inside the financial statement, is all in accordance to the required financial reporting standards. Okay, so all the engagement, they must be able to identify the criteria. So for instance, like just now, you want to evaluate the internal control. Okay, you want to develop the enterprise risk management. So you might perhaps look at the COSO framework. Okay, because COSO framework is actually talking about how to design the control and also risk management framework of the company. Okay, so that's why auditors must know your competency. All right, you must know the business knowledge, you must know the technical knowledge. All right, you must know the required regulatory requirements in respect of the accounting standards, in respect of the business practices. Okay, so because you are so-called considered as a business expert. Okay, and then based on the work that you do, definitely at the end of the day, you would have to come up with a report. Okay, so the report can carry certain value level of assurance. Okay, so in audit, the level of assurance is very high. Okay, you give reasonable assurance in the sense that, why? Because the nature of the work that you do is very extensive. Okay, very detailed. All right, very systematic. Okay, so for that reason, audit is always the highest level of assurance that provided. Okay, other than that, in other assurance engagement, normally the level of assurance would be slightly lower than level of assurance provided in the case of audit. Okay, but whatever it is, you must come up with your opinion, conclusions, or report. Okay, it's just that the level of assurance is a bit different depending on the nature of depending on the nature of the procedures that you do. Okay. All right. So here, coming back like just now. Okay. So all this must be clarified. Okay. Because all this must be stipulated in the engagement letter. Okay. It must be included in the engagement letter so that you know at the end of the day, because at the end of the day, you come up with a report, right? So some report can be distributed to any party. Okay. For instance, like in the case of audit. Okay, you come up with the audit opinion, right? So of course, ultimately in the audit opinion, you address report to the members or shareholders of the company so and so. Okay, that means ultimately the report is actually to shareholders. But because that audit opinion is being included in the annual report and the annual report later on being uploaded in the website, which later will be used by any public whoever want to access to that report is allowed. Okay, so in other words, distribution of the report is given to anyone. Okay, that means it's not being restricted. So in that case, okay, somehow or rather the liability exposure for auditor who are doing the work or the job on that financial statement is huge. Okay, the financial statement is huge, so that's why it's very important to mention all the parties that involved. Okay, because if you recall back, okay, in your professional liability topic, okay, if you can remember, you have your you must be able to connect, okay, you must be able to establish whether the party that sue you, is it present, okay, are you actually presence in the contract or you're not present in the contract. Okay, there's the term there, I forgot already the term. All right, so are you the liable party that you are you the intended user? Okay, if you're not, then actually you have no connection, you have not you do not have a strong basis to sue auditor on the basis of the breach of contract, therefore you go on the negligence basis. Okay, because in the case of the audit of the financial statement, the report can be used by anyone. Okay, because at the end of the day, if you realize, everyone who wants to make a decision, they will use the report given by the auditor, and from there they make the decision, and sometimes they incur damages, so they want to get claim for the damages from the auditor. Okay, so that is the deep pocket syndrome. So that's what happened. So for that matter, for that matter, that's why it's very important to specify who are the parties that involved. Okay, because later on, when you look for a certain assurance engagement, the distribution of the report are restricted. Okay, so the distribution of the report are restricted. So there are certain differences compared to if we were to compare across different engagement services or assurance services. Okay, in the sense of the level of assurance would be different, in the sense of the distribution of the report also would be different. Okay, all right, so here we really have to know who are the intended user. Okay, for that matter, we know if the report is restricted to in the distribution, hence we only know that this report only to be given to this particular intended user, not other than that. Or even sometimes responsible party also, we don't actually give the final report, okay, to them. So bear in mind, the intended user and the responsible party can be the two different party or can be the same party. Okay, it can be the company who wants to use the service of the audit firm, and they are the one also rely on the report. So it could be that way, or it could be like A and B just now. Okay, another company want to know about another company. Okay, so that's why it has to be mentioned clearly in the engagement letter who are the parties that involved. Okay, subject matter is also important, okay, because subject matter can be anything. All right, in the audit is clear cut. We know the scope is financial statement audit, but here in the assurance engagement, it can be anything. It can be historical information, it can be current information, it can be future information. Okay, it can be financial or even non-financial information. It can also be a particular business process. Okay, for example, you just want to focus on the how to improve collections of the receivable. Okay, so for that matter, you want to just look at that particular cycle, or maybe you want to improve your inventory management, okay, because you have problem on your inventory turnover. So for that matter, you just want to oversee the flow of the inventory cycles and so on. All right, so that is more on the business process or system. Or maybe you want to improve the values and culture of the company. Okay, because nowadays we are talking about effectiveness of the governance. Okay, so perhaps you want to audit board of directors. Okay, so to be much easier, normally you get the independent party to audit the board of directors. Okay, so you actually assess the governance practices, or maybe you want to assess the level of the compliance of the company towards certain regulations, policies, and so on. So there are many angle that a company could request the audit firm to do their work. Okay, especially nowadays with the promotion of the encouragement to further explore on the agreed upon procedures, many more could be done. Okay, especially if you see the pattern nowadays, company are using sustainable reporting. Okay, but that one is not, apart from annual report, they include also sustainable reporting, but that is not part of the audit scope. Okay, so perhaps they want to increase the value of the information, then perhaps they would like to do assurance services on that particular scope of information. Okay, so whatever it is, for every subject matter, you would actually find the respective framework or benchmark to refer to, because they want to ensure that the procedures that they do, and then the what is this? The practices that they do is actually in line with the required benchmark or standards. Okay. Then talking about the time frame, so as I mentioned just now, it can be past, current, or future. Okay, the engagement process, normally how to do the work is defined by the respective standard. Okay, if you remember, when you do audit, you always refer to ISA, International Standards of Auditing. Okay, International Standards of Auditing. But in the case of assurance engagement, they have many other types of standards. Okay, for instance, like ISAE, International Standards of Assurance Engagement, or they also have ISRE, International Standards of Review Engagement, or maybe they have ISRS, International Standards of Related Services. So there are specific standards that being issued to guide the practitioner how to do the work, how to perform the engagement. Okay, so that's why when you do that particular specific engagement, you must ensure that it is actually in line to the required procedures that being stipulated in the respective standards that being issued actually by IFAC under auditing board. Okay, auditing standard board. So as I mentioned just now, level of assurance are different. Of course, audit give the highest level of reasonable assurance because you come up with the appropriate evidence, okay, to substantiate that the figures in the financial statement is true and fair. Okay, you do extensive audit procedures, you do extensive collection of the evidence, okay, and then the way that you do the process also very systematic, where you have your planning. Okay, you do some procedures in the planning, and then you have your field work. Okay, so a lot of procedures, systematic procedures involved. So that's why audit give the highest level of assurance, okay, reasonable assurance, compared to other type of engagement where only very limited. Why? Because the nature of the work performed or procedures performed is very little. You only substantiate a very limited evidence, okay, to support your claims or what your opinion, conclusions, and so on. So that's why certain engagement give very limited assurance, certain engagement give no assurance at all. Okay, so these are the things that we have offered by the audit firm or public accounting firm. So why actually, if you refer to the engagement just now, you have your practitioners, you have your intended user, and then you have your responsibility party. Okay, why practitioners are being appointed? Okay, the main reason is mainly because of the independent status of the practitioners. Okay, that means you have no interest in the intended user. You should not have any interest in the responsible party. Okay, so you must be free of the conflict of interest from this party. And apart from that, you are also competent. That means you are known for your business expert. Okay, you are known for your knowledge of the industry. You are known for the technical knowledge. Okay, so that's why you are the best source to get access to the relevant expert for you to evaluate whether the information that you are evaluating is actually accurate, reliable, and so on. Because at the end of the day, the main purpose is to provide assurance is simply because to enhance the credibility of the information. Okay, the scope just now. All right, the scope of the subject matter just now. You want to enhance the credibility of that information. Okay, because you want to improve the level of confidence. Okay, for instance, like you get the work on the financial statement because you want to go for the bank loan. Okay, so that bank could rely on that information. They know that information has been checked, has been validated. Okay, so that they can actually make a more effective decision making. Okay, for the purpose of their business and so on. So again, is actually to enhance the confidence and trust of the people in order to make better decision, okay, based on credible information. Okay, so that's the reason why we have many types of assurance engagement. Okay, when practitioners provide assurance engagement other than audit, not necessarily they are like, okay, given that just now they give no assurance or perhaps limited assurance, right? Not necessary that they did not have to comply with other things. Okay, so the similar requirements also apply to them, whereby they need to comply with the ethical requirement, meaning that they need to comply with the MIA. Okay, they need MIA by law. They need to comply with the ethics requirement under Companies Act. At the same time, they also need to comply with the exercise the professional judgment, even though they don't have to like corroborate so many audit evidence to support or substantiate their audit procedures or whatsoever, but still they have to apply professional judgment. Okay, because they are later on when you see uh, during the course of the assurance engagement, they found some suspicious, so they decide to withdraw whatsoever. So they have to know, okay, what they need to do based on the ethical requirements, and that's why professional judgment still need to be applied. Skepticism needs to be applied. And then when they perform their engagement, okay, they must ensure that it is in line with the quality control requirement. This is actually referred to ISQC1. Okay, quality control, international standard of quality control, where they mention when you have your engagement performance, what do you do? Okay, at the point of being offered the engagement, what do you do? Before you accepting the engagement, what do you do? Before you continue with the engagement, what do you do? Okay, have you assessed your independent or not? Have you assessed your competency or not? Okay, have you assessed your capability or not? Okay, so all these things must be done. All right, and then when you perform your procedures, do you ensure that your procedures are all in line with the required standards? Okay, because when you are being being audited on the practice review or AOB basis, okay, you should be able to mean you can guarantee that you fulfill the requirement of the quality control. Okay, so because at the end of the day, it reflects the quality of the work provided by the practitioners. Okay, and simultaneously, documentation also must be done. All right, documentation of the working paper are all still need to be done. All right, okay, it might not be extensive as compared to audit, but they are some kind of working paper. Okay, because if anything happen, you have something to back up. Okay, that you have done this, that, and so on. Okay. And then communication in terms of the report, it actually depends on the nature of the engagement. Okay, the format of the report, because it depends on your procedure, it depends on your responsibility, also depends on the level of assurance that you are trying to provide. Okay, so the report is certain have a standard or template to refer to. Okay, if it is a common, because for certain engagement, maybe because of the nature of the required scope of work, the required scope of procedures will be different. Hence, the report might not be standardized. Okay, so that is actually what practitioners must comply or must exercise when they deliver the engagement. Okay, Non-audit assurance services or related services being stipulated here is example of ISA 800, special purpose audit. Okay, like when you want to do due diligence, okay, in the case of merger exercise or takeover exercise, all right, so you might want to do due diligence, right, on that particular company. So this is where the practitioners come in and do a special purpose of audit, okay. And then you have assurance engagement, whereby this is ISAE 3420, prospective financial information. All this will be explained in detail later on. And then you have review engagement, ISRE 2400, and then you have related services, okay, ISRS 4410 and also 4400. Okay, compilation and agreed upon procedures. What is special purpose audit? Okay, special purpose audit is actually when audit firm is being appointed by a particular, it can be the management of the company, it can be a third party, okay, a third party which is intended user who wants to assess on another party, on another company. All right. Whoever it is, you identify the parties and then the scope. So under special purpose audit, the scope is normally already defined by the intended user. Okay, already defined by the intended user, because it can be anything, right? It can be anything on earth that you want the assurance practitioners to provide assurance on it. Okay, so uh, the work scope can be like, for instance, in here I showed to you tax basis of accounting financial statement, the company and entities tax return. Okay, for instance, what the company want to do is that normally when you prepare your financial statement, it is actually telling you how much is your accounting profit. And of course, accounting profit is different from tax profit. Okay, so that's why you do your tax computation starting from profit before tax, and then you derive to your chargeable income for tax profit. Okay, so what the company wants here is that they want the reporting to be prepared based on the requirement of the tax requirement. Okay, because tax requirement, you have deductible, non-deductible, allowable, non-allowable, all those things, add back, double deductions, and so on. All right, so you want to prepare from that perspective, because you want to know immediately how much is your tax profit, and then what is the effective tax rate. Okay, because you want to plan for your tax planning forever. Okay, so that is what they can do. Okay, so they can actually ask the client, the audit firm or practitioners to do it, okay, for them. Or maybe they want to have like, in the case of about to liquidate or they being claimed soon bankrupt. Okay, so of course they are eligible to settle all the liabilities to the creditors, right? So the creditors might want to know the net worth of the company by knowing how much is your cash available, okay, in order to meet the settlement of all the liabilities. So maybe they want the company or the practitioners to prepare the cash receipts and disbursement basis purely based on the cash. Okay, because in our accounting we have accrual basis, right? So some are accruals and so on. So they really only want to know the cash in and cash out. Okay, cash flow statement or cash flow information. So they will really want to know what is the cash flow status of the company. Okay, so this can be very specific. All right, but when you're talking about ISA, it is International Standards of Auditing. It's a special purpose audit. So the nature of the work could be as extensive as compared to audit. Okay, so this is what the practitioners can do. And of course, because of the scope is very restricted, okay, very focused, depends on the need of the user. So therefore, most of the time, the report cannot be distributed, okay, to anyone. So the distribution are restricted, only being used by the intended user. Okay, so this is regards to the special purpose audit. This is an example. Okay, this is an example of how the special purpose is being done on the valuation of the company, because for this company, what they want to know is what is the value of assets for the company for the couple of years. Okay, so this is what they combine all the assets, information on the assets, and then they verify the figures of this particular assets. Right. So this is because it can be very specialized. Okay, you just want to know the net worth of the company or the net assets of the company. Okay. Okay, the next one is the prospective financial information. Okay, under the prospective financial information, now you are talking about assurance engagement, but for future financial information. Okay, because prospective is referred to forecast and also projection. So forecast, normally you come up with the figure based on the best estimate assumptions, but projection normally refer to the hypothetical assumptions. I mean, you come up with a hypothesis. Okay, given this, what will happen, right? So as an auditor, you normally decide what would be the best basis or assumptions that being used. Is it realistic? Is it reasonable? Is it consistent with the historical financial statement or not? Okay, for instance, let's say you want to go for IPO, you want to show your profit forecast for 5 years. Okay, so all this while, the trend of the financial statement is sales increase range between 5% to 10%. Okay, that is the pattern or trends of the company's pattern. But when it comes to the forecast, you decided that you think the sales could increase 20% on yearly basis. Okay, so as an auditor, you have to decide, is it reasonable? Okay, all this while is only within that range, and suddenly now the forecast is higher than the historical information. So it's kind of like not reasonable. Okay, unless they can prove that the basis how they can sure the revenue increase by 20%. Okay, so you have to assess that. At the same time, you also have to see, is it reasonable or not with the current conditions? Okay, if they are doing their business in Malaysia, how is the situation of the business in Malaysia? What is the economic growth? What is the market demand? If they are doing their business overseas, so perhaps you want to go to check the information of that country. How is their pattern of the economic growth, okay, or industry growth of that particular country? So you need to assess the reasonableness of that information, okay, because it's all about future, a lot of uncertainties, okay, a lot of uncertainties. So how sure you are that information is actually accurate and reliable. And then of course you have to look at the period cover. Okay, it depends. Some like maybe 1 year, some maybe 2 years, some maybe 3 years, 5 years, and so on. Okay, depending. And normally it will involve a profit forecast and also financial position and also cash flow. Okay, the most common financial statement. And then the report can be modified or unmodified. Okay, it depends whether when the clients, because all this prepared by the client, so you just come in and verify, right? So it's either you modify some information or you don't modify their information. That means whatever that they have calculated is actually acceptable. Of course, your benchmark or identified criteria would be all the relevant regulatory requirements, okay, such as Companies Act, Securities Commission, Bursa listing, MFRS, and so on. So when you do prospective financial information, you must ensure that the evidence, when you gather your evidence, is supporting, okay, is validating the assumptions that you have. Okay, assumptions regardless whether it is the best assumption or whether it is hypothetical assumptions. Okay, that means whatever claims by the management, it is actually reliable. All right, so that means then we perform the recalculation of the prospective Is it true that figure is actually based on that assumptions? Has it been calculated correctly or not? Okay. And then, of course, all the assumptions must be disclosed in the notes to the accounts. Okay. So, that means you have to check lah. Okay, in the notes to accounts, all the assumptions being explained clearly or not and whatsoever. Okay, because the reader, whoever read your report, if it is distributed to all party, especially this in this case prospectus, of course, being used by the public, and okay, so must make sure that the whatever need to be disclosed are being disclosed properly. Okay, are being disclosed properly, and it must also be consistent to the historical information. This is an example of how pro forma statement look like. Okay, so you can see here. Okay, you see the pro forma statement, financial position as at 31st December. Okay, provide illustrative purpose. Okay, so this is just an illustrative. Okay, because it's not yet happened. This is what they plan to happen. Okay, this is what they plan to happen in future based on the assumptions that they made. Okay, so here the illustrative purpose to show the effects of the transactions and event. Okay, so what happened here is that they have the baseline. The baseline is the audited financial statement as at 31st December 2016. So based on that baseline, based on that audited financial statement, they come up with the proposed event, which is the first event, pro forma 1, is to propose right issue. Okay, is to propose right issue. So when they propose right issue, of course, it would increase their cash and bank balances, right? The rest would not change. Okay, so you can see that there is an increase in the cash and bank balances. Okay, so once cash and bank balances, so the second event is that they want to do proposed acquisition. So here under the pro forma 2, they have taken into effect pro forma 1 event plus pro forma 2 event. So that means they get the money from the right issue and then they do acquisition. So of course now the money from the cash will be lesser, and that money is actually being transferred into investment property. Okay, so that is actually what they're trying to show. As a subsequent to the event, what is the impact that happened on the financial position? Okay, and then pro forma 3 is after pro forma 2, meaning right issue have been taken up, acquisition has been taken up, so now they want to propose issuance to manager. So what is the impact? Okay, so here you can see that there is an increase on the investment and properties as well. So here is actually to show to the readers, whoever the users of the financial statement or the pro forma financial position, this is what happened, to give them information. Okay, so to give them information, what would happen to the financial statement after the events or take place or the transactions take place. Okay, so of course, as an auditor, you have to verify this figure. Okay, you have to verify this figure. If they say that right, you should get this amount, how do they get that amount? So you have to perform the recalculation, okay, reasonableness of that information and so on. Okay, so that is what auditors do. Okay, the next one is a review of financial statement. Okay, review of financial statement. This is very common for quarterly reporting. Okay, if you all know, listed company, they have to do quarterly reporting, right? Okay, that means they have to declare first quarter, second quarter, how much is the profit, how much is the loss, or whatever and so on. Okay, so before they disclose that, they have to make sure that that statement have been reviewed by the practitioner. Okay, has been reviewed by the practitioner. So normally when they appoint before they want to declare in the reporting, quarterly reporting, they will ask the practitioner to come in and perform the review. So normally practitioner will just go and inquire and do some analytical procedures. Okay, and then perhaps just double check whether the figures is actually tally to the management records or not. Okay, so if they say revenue 1 million and then they check to the GL, is it revenue 1 million or not? Okay, and then they inquire how come increase from last time 500,000 now half 1 million, something like that. Okay, you just query. But of course, by doing a very minimal procedures, okay, because you just do inquiry and analytical procedures and perhaps just verify the figures to the management record, you still have to apply your professional skepticism. Okay, you still have to apply professional judgment. For instance, if let's say last quarter, because normally when you report, if you read in the newspaper kan, selalunya normally they will say, okay, first quarter last year revenue is this much or profit this much. First quarter this year revenue this much, profit this much. So from there, by right, is comparable lah. Okay, of course it will increase, but reasonable kind of increase. But if let's say it's increased so significantly, then perhaps auditor would like to, or practitioner would like to apply a judgment. Okay, is that figure is reliable or not? Because you did not do extensive work to find evidence and so on. Okay, you just a mere review only. So you have to apply your judgment. Okay, is it make sense or not? Okay, so maybe you will look at quarter 1, quarter 2, quarter 3, quarter 4. And then, I mean, is the pattern or trend is actually not an abrupt increase. Okay, if you were to compare quarter by quarter, for instance. Okay, so you have to apply, all right, your judgment. Of course, when you do your review, you always go back to your financial reporting standard, because especially when talking about impairment, okay, valuations of your financial instrument, all those things, because nowadays people are all talking about fair value, right? So how? Okay, how does that have impact on the financial statement that you want to declare for the quarterly reporting? So at the end of the day, it's either you issue modified or unmodified conclusion or report, okay? And just now when you apply your judgment, if let's say you decide that you cannot give limited assurance, okay? And you cannot give, I mean, qualified opinion also is insufficient. That means you cannot come to your final conclusion, okay? You might want to decide to withdraw. Okay, so it's also applied the same thing, meaning that in any engagement, right? In any engagement, that's why just now during the acceptance is very crucial for you to assess. Should you accept or not accept? If you accept, then you have to proceed because you already signed the contract engagement letter. But once you already signed the contract engagement letter, then during the course of the engagement, then suddenly after you apply all your judgments on, and then you decide that now you don't think that you can continue with the engagement, you want to withdraw. Can you withdraw or not? Okay, what is the implication if you want to withdraw? Okay, so that's why as what you have done in your project, and okay, that means as an auditor you have to know your duties and responsibility, your rights, your powers. Okay, in any engagement, what is your rights, what is your power, what is your duties? Okay, because actually auditor practitioners can withdraw in any engagement. But of course, when you want to withdraw, you must make sure that your liability exposure is very minimum. Okay, because I don't think that they want to withdraw with a big liability exposure unless they take the risk lah. Okay, so that one is depends case by case basis. But of course, the general idea, you can withdraw, but if you want to withdraw, most of the time it will be very limited liability exposure. Okay, all right. So that's what happened in the review of financial statements. So very minimal work. That's why level of assurance are also very limited. Okay, this is an example of the report issued for the review. So you can see, because this one quite common, right? Because every quarter they have to do for the client. Okay, by the way, normally for review of financial statement, the company would appoint the same auditor. That means who are the auditor of the audit firm, they are also the reviewer of the financial statement for quarterly reporting, because it's covered the same, more or less the same thing. Because at the end of the day, these two engagement would actually cover the financial statement as the scope of the work. Okay, but in the case of other engagement, the company can actually appoint another practitioner. All right, so it can be a different practitioner for a different engagement. That one is no problem. All right. Okay, so here you can see that in the report, they also specify what is the auditor's responsibility, okay, about the independence, all right, and finally the conclusion. So if you see that, based on our review, okay, this is not an audit, all right, so it's clearly been mentioned in the report, okay, to remind the user of the report or whoever read the report, this is not an audit. This is just a review. Review means the word is inquiry, analytical review. That's all. All right. Or perhaps very minimal of tracing, okay, to the records to ensure the completeness and accuracy. All right. So this is another example of report. But of course, for different engagement, different report. Okay. And then you have ISRS 4410 compilation. Okay, compilation, this one, if you notice, this is not an assurance engagement. Okay, this is related services, but not an assurance engagement. Meaning what? Meaning there is no assurance given. Okay, it's not given any level of assurance. They just practice that actually assist in preparing and presenting financial information of an entity. Example, like accounting work. Okay, because accounting work, what happened is that company client will give all the accounting documents to the company, okay, to the practitioners, and then practitioner will prepare the accounting, but the policy of the accounting, all right, for instance, accounting policy, revenue recognition policy, depreciation policy, apa lagi, whatever lah policy, okay, whatever judgment that need to be done, to be decided by the management, management have to do it. Okay, it's not being decided by the practitioner who prepare the accounts. Okay, maybe they can advise, but ultimately decision is being made by the management. Okay, because that is the responsibility required under ISRS 4410. Okay. So at the end of the day, the report this one will be in the form of financial statement. So you see, different engagement, the report is different. It's depending on the nature of the work provided, okay, for the respective engagement. Okay, so here, compilation for many reasons. It can be for the purpose of the specific reason. Okay, like to prepare financial accounts, of course required, right, for the company to prepare the accounts just now. Or maybe for the grant reporting. Okay, maybe for instance, you get the grant from a certain company or from certain institution, and then they want to know how you spend the money from the grant. Okay, who do you buy, what do you buy, okay, what do you purchase, who use it, whatsoever lah, the details report of how the money from the grant is being used. Then you might, because they want the independent party, right? So they can actually appoint practitioner to come in and prepare that report. Okay, so again, it depends. All right. So in this case, it depends on the purpose of what. Okay, purpose on what they actually, what kind of report that they want to look for or they want to use. Okay, what they want to use. So that's why I said it's all go back to intended user. Okay, what they want to know, what they want to use, then they would actually tell the practitioner, this is what you need to do and so on.